It's Thursday morning, January 22nd, 2026. Right now, silver is hovering near $95 an ounce, just below the all-time high it hit yesterday at $95.08. The headlines are everywhere. Record-breaking precious metals rally, safe haven demand surging, retail investors cheering. And if you're watching CNBC or scrolling the usual financial feeds right now, you'd think this is the moment, the confirmation that the metals supercycle has finally arrived for everyone who's been stacking physical. But here's what they're not telling you. While silver is making these emotional parabolic moves, so intense that retail traders are refreshing their portfolios every 5 minutes, there's another metal sitting around $5.89 per pound that's doing something far more dangerous. Copper is holding firm, not launching into the stratosphere, not collapsing with risk assets, just holding. And that stability, that refusal to break lower, despite everything happening across broader markets, is more revealing than any record high flashing across a precious metals ticker. I'm not here to pump hype about the next big squeeze or talk you into panic selling your stack. I'm here because I saw something this week that couldn't wait. And real quick, if you want these kinds of calm, no hype breakdowns from Chill Guy, hit subscribe. This channel is built for people who want signals, not noise. Because while everyone is watching silver make history, I'm watching what institutions are doing in the shadows. And it tells me the real story is not about fear trades and safe havens. It's about what happens when the world's biggest corporations realize they can't trust markets to deliver the physical metal their future depends on. Amazon Web Services just bypassed the entire public commodity market to lock in copper supply directly from a mine in Arizona, not through the London Metal Exchange, not through COMEX, direct. A 2-year offtake agreement worth $25 million per year. Samsung is doing the same thing. Apple just committed $500 million into rare earth projects. These aren't speculative plays where a hedge fund manager is gambling on volatility. These are strategic supply grabs by companies that ran the math and realized they cannot afford to be caught without the wiring metal that powers every piece of infrastructure they're building over the next decade. So let me ask you something. If copper is just another industrial commodity that rises and falls with the economy, why are tech giants locking in multi-year supply contracts right now? Why are they willing to pay premiums to guarantee delivery when they could simply wait and buy on the spot market like they've done for decades? Your screen is telling you silver's record high is the story. The shadow market is telling you copper's stability is the warning. And if you think what's happening in precious metals is the only thing that matters, you're about to miss the structural shift that's been building for over a decade and is now breaking into physical supply chains in a way most people won't understand until it's already too late. Because what we're witnessing is not just a rotation from defensive assets to industrial metals. It's the moment copper stops being treated like a commodity you buy when you need it and starts being treated like a strategic resource that technology companies are front-running before public markets even wake up to the fact there's a physical shortage coming. This is the great decoupling, and institutions aren't waiting for CNBC to confirm the trend before they position. Here's my primary claim, and I need you to understand it clearly, because everything else builds from here. Copper is no longer being valued as a cyclical industrial metal. It is being repositioned as a strategic tech asset, one that Amazon, Samsung, Apple, and every major player in AI and electrification are securing before public markets even comprehend the scale of the structural shortage. This isn't about riding short-term volatility. This isn't about trading the next hype wave. This is about recognizing that while silver makes headlines with emotional spikes driven by fear and speculation, copper is quietly becoming the physical bottleneck for critical infrastructure being built right now. We're watching what I call infrastructure decoupling. Gold and silver are being treated like insurance policies. You buy them when you're worried the system is breaking, when currencies lose trust, when you want to preserve wealth in something that held value for thousands of years. And don't misunderstand me. I stack physical silver. I've been in that world for over a decade. I understand the thesis. But copper? Copper is being treated like oxygen for infrastructure. It's the metal you secure when you're building the future, when your business model depends on data centers that require 10,000 tons of copper each, when your EV production line cannot function without supply locked in years ahead. And here's the uncomfortable truth mainstream financial media refuses to touch. Physical supply cannot respond to this demand for at least a decade, not because of a temporary bottleneck that clears when prices spike, not because logistics are slow, but because of the physics of mining and the geological reality of what's still left in the ground. It takes 13 to 15 years to bring a new copper mine online from discovery to production. Ore grades have dropped roughly 30% since 2000. The easy copper has already been pulled out of the earth. Meanwhile, demand is accelerating at a pace that would have sounded insane just 5 years ago. So in this breakdown, here's what I'm going to do. First, I'm going to walk you through the market structure we're seeing right now. Specific price action, inventory data nobody's focusing on, and institutional positioning happening in real time while the mainstream keeps writing yesterday's headlines about silver's moonshot. Second, I'm going to break down the demand shock driving the move, AI data centers and electrification creating non-negotiable, inelastic demand that doesn't pause just because the economy gets choppy. Third, I'm going to show you the supply crisis that makes this structural, not cyclical, collapsing exchange inventories, decade-long mine timelines, and geopolitical constraints turning official inventory into something closer to a mirage. Fourth, I'm going to address the strongest argument against this thesis, because if I can't defend against the best counter-argument, I have no business making the case. And finally, I'll share my personal read on what comes next, the triggers I'm watching and why this decoupling is going to catch most participants completely off guard. This isn't a trade for next week. This is a cycle signal that's been building since modern infrastructure demand began outpacing the physical reality of what mining can deliver. And it's about to break into public awareness in a way that forces a repricing of how we value the metals that actually power the digital world. Here's the promise. By the end of this breakdown, you'll understand why the real story today isn't silver touching $95. It's the shadow inventory withdrawals happening at the London Metal Exchange, and the private corporate supply agreements being signed that barely anyone is reporting on. Let's get into it. All right, here's the snapshot of what the market looked like this morning, Wednesday, January 21st, early morning Eastern Time. Silver around $95.10, up 63 cents from yesterday's close after hitting that record high. This is the kind of move that makes precious metals holders feel vindicated, like it confirms every thesis they've had about debasement and safe haven demand. Copper around $5.89 per pound, up only a tiny fraction, less than 0.5%. Now here's what matters about that copper price. While precious metals are ripping into records and headlines are screaming, metals mania is back, copper is barely moving. Not rallying, not collapsing, just holding. And in a market like this, that stability is more revealing than any moonshot. Let me explain. When you look at copper's structure right now, you're seeing heavy liquidity support around $5.89, despite every reason copper should be selling off with broader risk assets, despite the fact industrial metals are supposed to weaken when uncertainty rises. Copper is refusing to give up key structural levels. This is what I call tectonic stability. It's not flashy, it's not exciting, but it tells you something. There are very large hands underneath this market, and they're not letting it break. Now compare that to silver. Silver is going through what the market would call a parabolic fear rally. It's emotional, volatile, and driven by safe haven demand, especially retail buying because they're nervous about geopolitics, monetary policy, and the dollar. And I get why that demand exists. When you see tensions escalating between the US and Europe over Greenland, when you see bond markets selling off globally, the first instinct as a metals holder is to load up on silver and gold, because that's what people do in uncertainty. But here's the key point. The paper market story and the physical infrastructure story are telling you two completely different things. While retail traders pile into silver for protection, physical giants like Amazon Web Services are signing multi-year direct offtake deals with Rio Tinto for copper. Think about that. Amazon isn't speculating. They aren't trying to flip a commodity for quick profit. They're locking in multi-year supply because they've calculated exactly how much copper they need to build and maintain the data center infrastructure that powers their cloud business model. And they're willing to bypass public markets and pay premiums above spot just to guarantee delivery. That is not normal commodity bull market behavior. That's abnormal behavior that signals something much more serious. It signals that one of the largest technology companies on earth has lost faith in traditional exchanges to guarantee physical delivery when they need it. So you have to ask yourself, what do they know that paper markets don't? What are they seeing in physical supply chains that makes them take this kind of unprecedented step? The silver rally you see on your screen is real. The record high is real. The safe haven bid is real. But the corporate panic building inside copper supply chains is real too. And institutions are not telling you to celebrate the precious metals rally while they quietly lock up every pound of copper they can through private contracts. I've watched commodity markets long enough to know when there's a disconnect this large between what retail is focused on and what corporate supply managers are doing, you follow the corporations, because they're the ones who actually need the physical metal to operate. Screens can show emotional volatility all day, but you can't print copper mines. You can't manufacture supply out of thin air when your construction schedule depends on securing 10,000 tons of wiring metal. Now I need to slow down here, because this next section is the foundation for why copper's stability matters more than silver's volatility. We have to talk about what's driving copper demand. This is where the structural story separates from the cyclical story. The demand shock hitting copper right now is not coming from traditional industrial uses that rise and fall with the economy. It's coming from two megatrends reshaping how much copper the world needs, and both are what economists call inelastic, meaning they don't slow down just because prices rise. They don't get postponed just because the economy weakens. They happen because the infrastructure build-out is already locked in, and there's no alternative. Megatrend number 1, artificial intelligence, the data center arms race. Let's put numbers on it, because most people don't understand the scale. A single hyperscale AI data center, the type Amazon, Microsoft, Google, and Meta are building, can require 5,000 to 10,000 tons of copper. That copper goes into power infrastructure, distribution systems, cooling equipment, backup installations, and high-speed interconnects. Now multiply that across the industry. These companies aren't building one or two centers. They're in an arms race to build hundreds globally over the next few years to support AI workload growth. According to S&P Global, global data center capacity is projected to rise dramatically over the next 2 decades. That build-out is expected to multiply copper demand from the sector by 2040, adding millions of tons of annual consumption. And here's the key insight the market keeps underestimating. Copper demand tied to the tech build-out has already surged sharply in a very short time, driven almost entirely by AI infrastructure expansion. This is demand that did not exist at this scale 5 years ago. This is a step change in consumption from an industry that has become mission-critical to competitive positioning in the tech world. Megatrend number 2, electrification. This is where the numbers get even more dramatic. A single EV requires about 183 pounds of copper compared to around 50 pounds in a traditional internal combustion vehicle. That's nearly 4 times the copper intensity per vehicle. And this isn't a niche change. This is every major automaker on Earth committing to EV-heavy lineups over the next 10 to 15 years. Global EV sales are projected to rise significantly from 2025 to 2028, and that incremental shift alone adds hundreds of thousands of tons of new annual copper demand, before you even account for charging networks, grid upgrades, and battery production facilities. Now here's why this becomes non-negotiable structural demand. When Amazon decides it has to build a data center to compete in AI services, it can't just delay the project because copper prices are elevated. Competitors are building. If they don't secure copper and move, they fall behind. When an automaker commits to retooling for EV production, it can't simply pause because the economy hits turbulence. They're locked into capital investment, factory transitions, workforce training, and supplier agreements. This is what I mean by locked-in demand. It's baked into the infrastructure requirements of modern civilization in a way traditional industrial demand never was. So even if we hit a recession, you're looking at worst, a temporary slowdown, not a structural collapse. And here's the trap most people miss. Supply cannot respond quickly, even if demand softens temporarily. If we enter a downturn and copper prices pull back, mining companies cut exploration budgets, delay projects, and preserve existing operations. Then when growth returns, the supply deficit is worse because the development years you lost cannot be recovered. Now let's go to supply, because this is where the case becomes undeniable, where physical reality collides with what paper markets are pricing. Global copper supply is facing immediate shortages and long-term constraints that prevent it from responding like a normal commodity. The result is a widening gap between what the world needs and what producers can actually deliver. Start with exchange inventories, the most visible tightness signal. Since December, copper stockpiles at the London Metal Exchange have dropped sharply to around 114,200 tons. To put that in perspective, that's roughly 3 days of global consumption. 3 days. That is how thin the buffer is between normal market function and a real supply crisis. Some forecasts even suggest inventories across exchanges could drop far lower this year, down near levels that represent less than a week of global demand. But here's the part most market participants don't fully understand. That headline inventory number is not the real backstop it appears to be. A huge share of copper sitting in LME warehouses is of Chinese and Russian origin. And due to trade restrictions and certification rules, that copper is not accepted for delivery into certain Western channels, meaning it's not equally usable for every buyer. So the real accessible supply for many Western industrial buyers is a tiny fraction of what the official number suggests. This is why AWS goes straight to an Arizona mine and signs a direct offtake agreement. They see that the official data is masking deliverable scarcity. They ran the math. They know they cannot rely on exchanges for guaranteed delivery, so they step outside the system and lock supply at the source. Now here's why new supply can't fix this quickly. Bringing new copper to market isn't flipping a switch. Major producers say the average timeline for a new mine can exceed 13 years from project approval to first production. 13 years. So even with record prices and maximum incentive, meaningful new supply is more than a decade away, and it gets worse. What's left in the ground is lower quality than what's already been mined. In Chile, roughly a quarter of global production, ore grades have fallen substantially over the decades. In plain language, miners have to process far more rock to extract the same copper. That means more energy, more water, more material movement, higher costs, just to maintain current output, let alone grow. So now you have the perfect storm. Demand surging from AI and electrification. And it's inelastic because projects can't easily pause. Supply constrained by geology and decade-long mine timelines. And available supply that does exist is being pulled off exchanges into private corporate stockpiles via direct contracts faster than the system can replenish it. This is not a cyclical squeeze that resolves when prices spike. This is a structural deficit that can persist for years because mining can't respond fast enough. Forecasts project copper demand rising substantially over the coming decades, while supply growth hits limits much sooner. That isn't a temporary imbalance. That's a long deficit that cannot be bridged by small efficiency gains or recycling alone. Now let's deal with the recycling argument, because it's the myth people repeat to make themselves feel better. Yes, copper is highly recyclable, and a meaningful share of supply comes from recycled material. But here's the metallurgical reality many optimists ignore. Recycled copper doesn't always meet ultra-high purity requirements for advanced applications. AI data centers demand high-purity copper for certain cooling and interconnect systems. Next-gen EV motors and battery systems require extremely low impurities to maximize efficiency. You can't just melt old pipes and wires and magically turn them into high-spec copper for the most demanding applications. Metallurgy doesn't work like that, so recycling helps with baseline demand, but it cannot close the gap for the high-growth, high-tech sectors driving the structural demand increase. The supply crisis is real, the mine timeline is real, and the corporate response, bypassing exchanges and securing direct supply, is the clearest signal that the physical market is tighter than the paper price suggests. Now I'm going to pause and do something critical. I'm going to take the strongest argument against this thesis, because if I can't defend against the best counter-argument, then I'm just another voice pushing a narrative. Here's the bear case, and it's legitimate. A recession kills demand. Not a shallow slowdown, a prolonged global manufacturing recession where activity contracts, where corporate capital spending gets cut, where the AI build-out slows because companies prioritize cost-cutting over expansion. If that happens, the argument says, all this structural talk becomes irrelevant because copper is still cyclical at its core. In a severe downturn, demand falls, prices drop, and the so-called supercycle narrative breaks. That's the case, and I'm not going to pretend it's invalid. So here's my response, directly. First, yes, copper is cyclical. In a severe recession, demand would take a hit. I'm not going to claim copper is immune to weakness. But here's where the traditional cyclical playbook starts breaking. The corporate deals prove tech giants don't care about the PMI as much as they care about availability. Look at what AWS is doing. They're not trying to time price, they're de-risking supply. Because they know if they wait for a crash and then try to secure metal, the metal might not be there. That's the key insight. In prior cycles, demand was more deferrable. You could delay projects and wait. But today's infrastructure demand is less optional. If Amazon needs data centers to compete in AI, it can't delay forever. Competitors are building now. They secure copper now, or they fall behind. If automakers committed to EV timelines, they can't simply pause the transition without blowing up sunk capital investments. So even in recession, you're likely seeing temporary softness, not a structural collapse. And now, the supply trap. If recession hits and copper prices soften, miners cut exploration, delay projects. Then recovery comes, and the supply deficit is worse than before because you lost years in a system where new mines already take over a decade. So recession risk matters for near-term volatility. But long-term, it can actually reinforce structural tightness. Second skeptic argument, China. China is slowing. China consumes a huge share of global copper. If China goes into a prolonged downturn, demand falls. That's also a legitimate concern. But here's what it misses. China is also one of the biggest investors in renewables and electrification infrastructure. So even if construction-related copper demand softens, electrification demand can accelerate. And beyond China, other regions are still early stage in their own infrastructure build-outs. Demand is shifting geographically, less concentrated, more distributed. So yes, a China slowdown would hurt, but it wouldn't erase the global structural story. So here's the bottom line. The bear case is real for short-term price action. Copper could pull back during severe stress. But the structural supply deficit is real. Locked-in AI and electrification demand is real. And the inability of supply to respond quickly is real. So if you're thinking in weeks and months, sure, recession risk exists. But if you're thinking in years, the bear case breaks down because you cannot print copper mines. And the corporations who need the physical metal have already made the decision. They're securing supply now, not waiting for economic confirmation. So now that we've set the thesis, covered demand, showed the supply crisis, and addressed the strongest counterarguments, let's talk about what comes next. This isn't academic. This is about reading the market in real time and understanding what's happening beneath the surface while everyone else is staring at silver's record high. First thing I'm watching, inventory structure at LME and COMEX. If inventories keep dropping while direct offtake deals rise, that's confirmation the squeeze is moving off exchange. I'm not looking for a dramatic inventory crash. I'm looking for a steady grind lower, even when price is flat or slightly down. That would tell me price is no longer the main clearing mechanism. Availability is. When physical metal becomes scarce enough that companies pay premiums just to guarantee delivery, the market structure has changed. Second thing, the 550 floor. If copper holds above $5.50 during the next major risk-off event, that signals decoupling is sticking. It would mean copper isn't trading like pure cyclical metal anymore. It's trading like a strategic tech asset with a structural bid under it that doesn't vanish when investors get scared. Third thing, the spread between futures and physical premiums. If physical premiums start widening above futures, that's a classic sign the spot market is tighter than the paper market admits. That kind of divergence has shown up early in past supercycle spikes, paper still pricing modest growth, while physical trades at a real premium due to scarcity. Now I want to be clear, none of this happens overnight. This isn't a meme squeeze that explodes in a week and collapses. This is a multi-year structural trend that grinds higher so quietly most people won't notice until it's already happened. Price could chop between $5 and $6 for months. It could even dip hard if recession panic hits. But the fundamentals, supply deficits, corporate positioning, locked-in demand, don't disappear because of short-term volatility. Here's the scenario I think is most likely over the next 12 to 18 months. Precious metals stay volatile. Silver and gold whip around. Big up days, big down days. Retail gets pulled by headlines. Safe haven stories one day, policy stories the next. Talking heads keep calling tops and bottoms. Meanwhile, copper grinds. It holds support. It spikes occasionally on supply disruption news, but mostly it just refuses to go down. And quietly, corporate supply managers keep locking contracts. LME inventories keep declining. Miners keep reporting delays and cost overruns. And at some point, maybe late 2026, maybe early 2027, the market wakes up to the fact there's a structural shortage. Not because of speculation, not because of a short squeeze, but because the physical market has already been cornered through private channels and price has to adjust. That's the playbook I'm watching. That's the pattern I'm tracking. So let me bring it home with a 3-sentence recap. Silver is making headlines with record highs driven by safe haven demand and fear trades. Copper is holding structural support while tech giants bypass public markets to secure multi-year supply directly from miners. The shift from precious metals to industrial tech metals has already started. The ticker just hasn't announced it yet. Here's my final read, and I want to stay measured because hype ruins analysis. Over the next 12 to 18 months, I expect copper to grind higher in a way that frustrates bulls and bears. Not a clean, dramatic rally, more like choppy, range-bound action that builds a higher floor over time. But underneath that surface chop, structural forces are aligning. Corporate supply chains tighten. LME inventories decline. New mine development stalls. AI data centers and EVs keep pulling demand higher regardless of the broader economy. At some point, paper price has to reconcile with physical reality. And when that reconciliation comes, it won't be gentle. I'm not saying copper goes to $10 tomorrow. I'm saying $5 looks like the new floor in a world that has no choice but to electrify. And if you internalize what it means for a critical infrastructure metal to shift from commodity to strategic asset, you understand why institutions are positioning. So don't let silver's record high blind you to the tectonic shift inside physical supply chains. The era of copper as just another industrial input you buy when you need it, that era is ending. The era of copper as strategic tech infrastructure is here. While mainstream media writes celebration pieces about precious metals mania, smart money is securing the one metal that can't be printed, can't be synthesized, and can't be substituted for the infrastructure powering the digital future. You can ignore it, you can wait for financial networks to confirm it, you can tell yourself the deficit is exaggerated, or you can look at what Amazon is doing, what Samsung is doing, what every major company building an AI-powered electrified future is doing. They're locking copper directly from mines, often at premiums. They're not speculating. They're not trading. They're acquiring a strategic resource they cannot afford to be without. And the question you have to ask yourself is this: are you positioning for the world as it was, where commodities were flexible and markets always delivered? Or are you positioning for the world that's forming now, where the metal that powers everything is being locked inside corporate supply chains before it ever reaches public markets? The precious metals rally, that's today's headline. The copper supply crisis, that's the story of the next decade.